Good afternoon. It is Thursday, February 4th, 2010, and we had a pretty much a bloodbath here today, I guess. The S&P 500 lost about 3% here today, down $3.39. Obviously, that 38.2% retracement that we had been looking at on the 30-minute time frame here of the what had been the range for the year did find that the sellers yesterday, we had a slightly lower high in the afternoon, but the big story was that it gap down below this prior resistance level and the 5-day moving average and just continued to bleed in here. So we've been talking about the lighter volume of the rally and that was reason to be suspicious, but not reason to get short while the market was rallying over here. In particular, we're talking about the NASDAQ, but the S&P 500 is clearly quite damaged here. We've got a declining 10, 20, and 50-day moving average, and we could still see lows down near 103 area. We've closed this gap decisively. A lot of people last week thought that was a level of support. And as I've been saying the whole way down, that when we're looking at these levels, like the 50-day moving average, like some of the trend lines we've been drawing in, that they are potential levels of support where the market may encounter enough demand to offset the supply that's bringing about the decline. But it's not a reason to buy. What we want to do always is we want to look at these areas on the bigger time frames and then drill down to shorter term time frames. The whole concept of trend alignment is to make sure that we have an uptrend on the daily time frame as well as the 30-minute, the 10-minute, the 2-minute, or whatever time frames you choose to engage the market on. Realistically, for a longer term investor, you still have to look at this market as innocent until proven guilty with a rising 200-day moving average. To me, it seems kind of insane to still be bullish when we've had this type of decline, which is why I focus on the shorter term movements. And realistically, the most important moving average for an intermediate term trader is this 5-day moving average, and where is the market in relation to it, and what's the direction of it, and where does that fit in with the 50-day moving average as well. So it's a complicated puzzle. There's nothing easy about it, but if you play a strong defense and you're able to move to the sidelines during times of uncertainty, you're going to withstand or sidestep rather a lot of these big sell-offs and be in a good position to take advantage when the trend becomes clearer. Because today it was you basically had to be short coming into today to take advantage of this, because we had gapped down and then sold off so hard. There was barely a bounce in here right at the open. I mean, what I like to say always is we want to give it at least 30 minutes to kind of change course. That is, had we gotten back above this daily VWAP and then turned higher, then we could have tried, to think that maybe this market was going to try to turn around. But as I posted midday on Twitter, it's the cycle today was to kind of drift lower, squeeze the shorts, drift lower, make a new low, squeeze the shorts, and then that pattern was repeated over and over again. Except we closed right on the lows today. We've got the employment numbers coming tomorrow, and obviously the market is bracing for some bad news there. It's possible we could get a one of these gaps lower, then a reversal. But it's a very risky environment right now to be involved on the long side and to be looking for reasons for long entries. So the best phrase, I say it often, it's not mine, is that it's better to be on the sidelines in cash wishing that you were in than it is to be in the market wishing that you were out. And playing the strong defense is what keeps you on the sidelines here. The NASDAQ, as we had noted, had gotten up to the area where we had seen prior support, as well as that declining 10-day moving average on the daily time frame, and it got up there on really diminished volume. It was very pronounced the way that the volume trailed off in the NASDAQ, and as I said yesterday, that's not a reason to sell short, but it's a reason to be suspicious that of the sustenance of this little snapback rally. What we had seen in the NASDAQ today was we had obviously fallen short of that $44 level that we've been watching closely, the prior support, which did turn into resistance last week, and gap lower in there and just continued bleeding. The the semiconductors have been broadcasting that the NASDAQ was likely to continue to be weak, and the semiconductors are they were down another 3.8% 1% today. So these, the semiconductors are really getting hammered this year. Just about to touch this 200-day moving average. A lot of times that is an area where the market will begin to stabilize. So, it's possible that we could see maybe a little bit of a new low in here, and then a rally in the semiconductors, but there's really no evidence of it yet. What I like to look at is the moving average convergence divergence oscillators. When I get when we get to kind of these new lows, and take a look at that, and let me just continue to set this up while I'm here. But we do see that we are showing, not really even. It's not diverging, so that's not even. I was looking for, maybe there was some kind of evidence in there that the selling wasn't as intense. But we see, the volume, and you always want to look at volume as relative, not relative to the 20-day moving average. That's interesting in terms of, is there going to be enough liquidity for whatever I'm whatever I'm trading. But the volume is relative to the event, and the event in the semiconductors and the rest of this market has been these big red candles, and these big red candles, these big down days, have been coming on heavier volume in the S&P 500, in the Nasdaq, and the semiconductors that we're looking at right now. Relative to those declines, we've seen the rallies on diminishing volume, and that's a sign that the sellers or that the buyers aren't rushing in at perceived bargain prices. Instead, it's just a little bit of bargain hunting, but no real conviction behind it. The bigger conviction is with the sellers who are just hammering this market down. And we've been in this downtrend channel, and below the semiconductors in particular have really been held captive by this declining 5-day moving average, almost for the entire decline. We can see that it got briefly above that, but again, it's more the direction of the moving average that makes that you really want to pay closest attention to. So let's look at the Russell 2000. That market got hit hard as well, 3.3% in here today. So where is the potential for support likely to be found next? Well, we broke this trend line obviously today. We can back it up on a daily time frame to take into account more days, and we can draw all these potential support levels and trend lines and that sort of thing, but they're only reference points. They're not a reason to purchase. They're a reference point to say, here's where we have the potential and that sort of thing. But even the longer term trend lines are obviously broken, and these prior levels of resistance, and you've got to look at it and say, is it going to be the 200-day moving average that these markets settle into? On the Russell 2000, that's still down at 57, which sounds a long distance away, but it's only 2 points. It's not a big percentage move here, and we've definitely got some fear in this market. The financials, as we've been talking about, have been just kind of forming this classic little bearish flag in here, where they broke down on heavy volume, and the heavier volume days in here were on the downside movements as well. Today we broke that that bearish flag and got right down to where they were supposed to go, which is $13.80. Now that 13.80 has been basically the low end of the range of the financials over the last 6 months. We've still got that 200-day moving average, which is at about $13 and what is this? I think it's about 13.65. Let me just pull this up here so we can take a look. But the 200-day moving average is at $13.53. So, again, that's not a magic level where you want to stick a bid in. I'm sure there's people who will do that, and some people who've been selling might look at this and say, well, we'll start to cover our shorts down in that area, and it might begin to emerge as support. But what we want to do is we want to wait for the evidence to show that the buyers are taking control. Perhaps we'll even come down towards the $13.20 level from the March highs, but anyways, we're in a downtrend. We've got this this classic bearish formation that really we had seen also in the IYR. We were talking about some of the components in there yesterday, such as ARE, BXP, SPG. These all getting hit real hard in the IYR. Obviously, is as well. We'd seen lighter volume on this rally right up to the prior support and that 50-day moving average. Today, this this group, I was warning yesterday that a lot of times from a failed breakout comes a fast move lower, and that we all week we've been talking about the SRS, about it getting back above this $8.10 level, and then the $8.30 level, which were basically the same levels as this 44 level, and then the 43.20. So in other words, the 44 level was basically the same area as the SRS, $8.10, and this $8.35 level was basically the same as the IYR level, which was broken today as well, which is right here at 43 bucks a share. So the commercial real estate obviously is continuing lower in here. The weekly time frame, you look at it, it's still fairly bullish looking, but again, to me, when you have this type of movement lower and a declining 50-day moving average, there's no reason to be looking at this as bullish. It's broken the trend line from the March lows. So that doesn't mean that it's going to reverse altogether the weekly time frame, but it means that the rate of ascent obviously has slowed down in here, and that there's that we're in trouble. But we've known that by looking at the intraday time frames and shorter term time frames. In essence, the longer term trend is nothing more than the sum of a bunch of shorter term trends. So it's these short term trends that we want to pay the most attention to, and then get involved with them once they become aligned with the longer term trend, the path of least resistance. So it continues to be a dangerous market. We're in the middle of earnings season. We've got the jobs report tomorrow. We've got all kinds of political and economic uncertainty. So it's just continues to be a good time to preserve capital and keep your trades more short term oriented.